start. Very warm welcome to everybody for our second in our series of INAM Investors Workshops. My name is Oliver Hass. I'm Managing Director of INAM, and I'll be kicking off the event today. And we're very, very glad to have with us Benedikt Mahr from Weitnauer Rechtsanwälte, who will be talking about venture debt, a key building block in financing deep tech startups. But before we dive right into the topic, let me just, for those of you who don't know INAM, summarize what actually we do and what is that we're trying to achieve. So INAM is a non-profitable organization founded in 2016 with a mission to create an ecosystem around the topic of advanced materials and related innovation areas. So we've been trying over the last 6 years now to get the players such as corporates, small and medium enterprises, research institutions, startups, and last but not least, investors together to enable founders and innovators in the advanced materials space to move their products and businesses forward. Since then, we've developed an ecosystem that not only consists of our members, which span from Japan to Spain at the moment, many corporates, but also smaller enterprises. We have with us our legal advisors, Weitnauer. We have research institutions on board in Berlin, but also elsewhere. We have partnered with government in Berlin, but also beyond that. And finally, also we have our investment partners and startups, which we try to bring together wherever we think it is of mutual benefit. Now, the core of our activities is really our 3 startup programs. Traditionally, we ran the Advanced Materials Competition once a year, a 2-week acceleration program, which gives an intense exposure to startups in terms of training, but also in terms of mentoring. We've complemented this year with the Advanced Materials Lab, which is focused on the very early stage startups, sometimes not even incorporated, and the Advanced Materials Competition Scale, which is looking at the startups that are ready to scale, that are post-piloting, that are looking for the first structured investment round. Now, what do our members benefit, or how do our members benefit, depending on the group to which you're attached? Of course, it's, as I said before, it's a network bringing players from the various strands together. We have a significantly grown database these days where we keep track of our startups and where our corporate members do their scouting when they look for particular technology innovations. We design custom events such as innovation challenges or roundtables where we focus on particular topics and either do scouting or have discussions around that. And of course, as a member, you'll be able to join our startup program as, for instance, a mentor or contributor otherwise. Beyond that, of course, we're into the topic of internationalization, partly through our program Explorasia, which is focusing on China and Japan, so helping startups to expand into these markets. And of course, also beyond that, we share access to the mutual events that our members have. Now, that should suffice for the start, and I'd hand over to Benedikt Mahr to introduce us to the topic of venture debt. And I hope that after the discussion, we'll have quite a lot of food of thought to discuss and see where there are questions and how we can clarify. Thanks a lot, and over to you, Benedikt.
Thank you very much, Oliver. Very glad to be part of the investor workshop today. So now going to switch over to the other presentation, which I hope you can all now see. So yes, the topic today is venture debt. Venture debt is kind of the, let's say, new kid on the block regarding venture financing. And I hope we can take a deep dive today into what it really means, what are the pros and cons. And I look forward to also hearing your view afterwards on the topic and learning more which parts interest you in particular. So first of all, I would like to give a brief introduction of myself and the law firm, so you know who is presenting to you today. And then afterwards, in the second part, I'll focus on the topic, and then we can discuss further issues which are of interest to you. So first of all, my name is Benedikt Mahr. I'm partner at Weitnauer Legal and Tax Advice, based in Munich. And the areas I work on are corporate finance, mainly venture capital and private equity deals and transactions. So anything from equity mezzanine financing to other related topics, up to the exit of a innovation technology startup with respect to mergers and acquisitions. And we also focus on tax and fund structuring. So briefly on our firm, Weitnauer has been around for over 25 years now. So they've also seen the new market in the 2000 years, and have since then specialized in innovation and finance topics. So our goal is really to support innovation and to provide fast and efficient advice to our clients with direct communications. And as we are not a large law firm, but let's say a smaller boutique, can also have reasonable eye on fees. So this is one of our advantages which we have. Although we are a, let's say, a medium-sized law firm in Germany, we have a great international network of partners, which allows us also to participate in international transactions, as especially with venture debts and financing rounds, a number of foreign players are investing into European and especially German technology companies. So we can leverage this network as well. And also, as today with INAM, we have the idea of sharing our knowledge and experience to the group and to the venture capital scene, to help them to learn and also to help us learning from them, which are the key topics of importance to the venture capital scene and the network. So basically our slogan is that our goal is to support innovation, and that is where we see us. We don't see us as attorneys who really pose obstacles to transactions, but we are very solution focused and always try to present our clients with a solution that really solves the issue and helps with the transaction. As stated, we mainly focus on innovation technology and corporate finance as a boutique law firm. And just maybe 2 words on what that means for us. So innovation technology is basically IT and IP law, let's say from data protection to the protection of intellectual property to patent registration. Also then for the innovation parts, we look at particular topics that require, let's say, a further legal deep dive, life sciences, medical technology, also fintech, crypto, mobility, e-commerce. So these are all topics that really are new, are complex, and require a new approach, as we have a, let's say, a legal system that's been there for decades, but that really needs to adapt to any needs of modern and future technologies. Regarding corporate finance, we basically advise mainly in the venture capital area, so equity financing round, but also venture debt and, let's say, new and innovative financing means. And this really starts with the due diligence review of the company, then also finding a solution for the management to stay on and participate, general corporate housekeeping, conflict solution, and then also, well, with each financing round, bringing the company closer to an exit and a sale. And in that exit and sale, we also advise, and as stated, in cooperation often with our international cooperation partners, as those transactions and exits are often cross-border. In addition, we also focus on the advice for VC funds which is more, let's say, for tech structuring and a regulatory advice to make sure that all registrations are in place once the investment starts for the funds. So as the law is also evolving, we're looking at topics which are innovation for us. So where will we be in the future? And it is becoming more and more important for a law firm to also have a focus on legal tech and how we can use technology to become more efficient. So we don't have to send facsimiles or use dictation machines, which are then typed into computers by humans. So we're looking and cooperating with legal techs to become more efficient, and also managing our know-how and sharing our know-how in a very efficient way by using legal techs to support this, which then in the end results in an advantage for all of our clients. So we have 4 offices, the main office based in Munich, where I'm located, but we're also in Berlin, where INAM is located, and as well in Mannheim in the Frankfurt area, and in Hamburg. So this is just a brief idea of who we are and where we come from. So I joined the firm 5 years ago, and before that I worked 5 years in the venture capital area. First of all, the first 3 years as an attorney, but then for 2 years in the US and in Berlin for fintech startups and company builders. So really could combine, let's say, the legal transaction knowledge with an on-the-ground knowledge in startups, and really found my home at Weitnauer Attorneys, which really combines the innovative spirit with the legal and corporate transaction approach. So now, after this brief introduction, I'd like to move on and look at the topic which is of the most interest for all of you, venture debt. So as said, venture debt, the new kid on the block. What is it? Is it something that can actually help and support startups? Is it something that will increase in the future? Or is it something that just will appear and then go again? So let's look into that at more detail. So we'll start considering what is of importance to the startup, to the deep tech startups, and then see how the venture debt actually could fit into the, let's say, common and known structure of equity and bridge funding. So I'd first of all like to highlight from a, let's say, deep tech startup point of view, why would one come across the idea of actually asking for venture debt financing? So the key factors that and the issues to consider for any deep tech startup are, first of all, if there is a venture funding, what is my burn rate? How can I make sure that I have all my finances together in order to achieve my business plan, in order to achieve my goals? I will have the option to work with bootstrap financing or with friends and family funding, but this will not bring me to the place I would like to be in the future, because complex technologies as machine learning, artificial intelligence, and so forth, med tech or fintech, take a longer time than, for example, an e-commerce business. So it is really a question of how to scale this business, and for this reason, funding is vital. However, funding also requires a really solid balance between equity and debt. And a great danger is that if the debt ratio is too high, then a company may run into what we call in Germany over-indebtedness, and then may have to file for insolvency. So this is really important to always get the right amount between the different types of venture capital financing together. Then, of course, the financing is also very important to fulfill certain growth KPIs in order to hire staff, to buy new technology, or to acquire additional firms, and also to grow the business. However, with all financing also come covenants which need to be looked at, which may not and must not be breached. And this is also something which is to consider once I move away from the equity financing into venture debt, because the financial covenants, of course, with venture debt and debt financing are much stricter than with equity. So all these considerations should be kept in mind when looking at the right form of funding for a deep tech startup. So let's just briefly take a look what types of funding are actually available on the market and where does venture debt fit in. So we have the general equity financing, all known to you. Let's say the standard financing investment. An investor approaches a business and wants to participate in that business. Therefore, he agrees on an equity funding, possibly together with a group of other investors, and then will actually attribute funds to the business in consideration of shares and then eventually become a shareholder of the company. So this is a standard financing in equity. The advantage for the company, of course, being that such equity does not have to be repaid in the future. However, for an investor, of course, the consideration is, and that is, it is a long-term investment. The return on invest is probably one that occurs after 10 years. However, with respect to deep tech startups, it is unknown at the beginning which of the startups they are investing in will be successful. So it is a very risky investment for the investors. On the other hand, from a company perspective, there's no really, for this type of investment, there's no really leverage effect. So actually expenses for the financing sought cannot be deducted from the gain. So this is again something to keep in mind, why one should consider also looking at other means of financing. So I would say along with equity, and what is really known to the venture capital scene, especially in Germany, is the mezzanine financing. And in this context, especially convertible loans, which are a mean of bridge financing and kind of bridge one equity financing round to the other. So these loans are subordinated. So basically, this means in case of a liquidation, first of all, any external debtors are paid off at the beginning, and external creditors, and then the ranking of such mezzanine is the same rank as equity. So therefore, this has the advantage that in case of an insolvency, or let's say an over-indebtedness, such mezzanine financing is not calculated as external debt. So therefore, we don't need to take this into account in our equity and debt ratio. So this is very advantageous, let's say, to early stage companies to work with convertible loans, also because to combine an equity financing round takes a lot of work, it takes a lot of coordination, it is very expensive, you need to pay the attorneys, the notaries, you need to have a full-fledged due diligence. With all this in mind, and often the need of cash in a short-term periods, convertible loans are very, very popular in Germany. So these are actually, equity and mezzanine have been for the last, let's say, decades, the main financing source for any venture capital in Germany. The reason for that is that with debt, we only say, we only know the classical debt definition, right? You go to the general bank, you go to the Sparkasse, you go to the Deutsche Bank, and you ask them as a deep tech startup, could we receive a credit from you? And then most of them will say, well, which securities can you offer? And then the startup will say, well, we have a few Apple laptops and we have great engineers who work on an artificial intelligence technology that will change the world. And then Sparkasse or Deutsche Bank may ask, well, so do you have any revenues? And they will say, well, not yet, but probably in the future, and some revenues, but we are not at the break-even point. So bottom line of this discussion is that it is actually impossible for deep tech startups to receive loans, classical loans from a bank, because they cannot offer a security. And therefore the only way they receive some kind of credit is maybe if they get an overdraft, or if they get a credit line from their bank. And this really has hindered deep tech startups, or startups in let's say more complex areas where they don't have immediate revenue to really move to a next level, to receive a leverage effect, to receive external financing other than equity and mezzanine. Now there's venture debt. This is a very, let's say, fairly for Germany, new and an interesting new way of funding startups, and it's becoming more and more popular. So it is in a way a combination between the classical debt and the equity or mezzanine financing. It's a secured loan, and it carries also an equity kicker that is sort of, let's say, taken from a mezzanine financing perspective. Just to round up the picture of the financing world, there are of course also other forms of financing, let's say venture leasing, which is becoming more and more popular. Basically, if a company acquires, let's say in the medtech area, complex machinery for operation, or a complex computer, then those can be acquired and funded via venture leasing. And then there's of course, as you know, service media for equity, known as or known from 7 Ventures, ProSieben Sat.1, or also large corporation agreements. So this is sort of the scene we're kind of currently living in. And now let's look and take a deeper dive into venture debt, what that really means, and what it can do for deep tech startups. So general features of venture debt are explained quite swiftly. So it's a secured senior debt with an equity kicker. So secured means there's a collateral. So let's say anything the company has will be pledged, also knowing that maybe at the point in time, the company will not have assets of a great value, but those assets will develop in the future. So the main asset the company has as a deep tech startup is the intellectual property. It is the brand, but it's the know-how, and it is the machinery and the code that has been developed. So this is something of great value, as we see from the exits of very successful startups, and the understanding of the creditors and the banks that issue venture debt is that this is a very key value of innovation for the future. And that is the difference between them and, let's say, the classical banks who would not understand this great value. From a time perspective, it is a later stage financing. So this is not something for a startup that's really just in the first couple of years, because the requirement is that there is a certain amount of revenue required to be able to pay the interest. The effect for the shareholders, of course, for venture debt is there's no dilution. There's no dilution. So the shares actually keep their percentage, the shareholding in the equity of the company, in the value of the company, and also the voting rights stay the same. So on the other hand, however, any revenue from the company is then reduced by the venture debt, obviously, because interest has to be paid not on a final maturity basis as maybe for a mezzanine convertible loan, but it has to be paid on a monthly basis, and also the principal amount of the loan needs to be repaid. So there are significant payments. I will also highlight this further in a payment schedule, which I'll show you afterwards, so you can really see what the obligations for the company are. And this in mind, of course, has, let's say, a downside that the payment of interest and principal reduces the monthly gain of the company. However, as stated before, there's a leverage effect that actually the taxable income can be reduced by the interest payment, which is also an interesting effect for a later stage startup who really is mindful about the current taxes they are paying. So what are the requirements? The requirements for any startup to acquire venture debt is you need some equity, because without any equity, balance, you will not be able to receive venture debt, and we'll talk about the thresholds afterwards. Also, a revenue stream must be there in order to be able to pay the interest, and the business model must be scalable, which of course with any deep tech startup is usually the case. So now let's look into the different stages of financing and where venture debt actually makes sense for a startup. So first of all, the bootstrap phase of a startup, let's say the first ideas and the first 1 or 2 years of the startup, where actually the founders themselves invest their private funds into the company, let's say up to 50 or 100,000 euros, right? So in this phase, of course, venture debt does not make sense. Then the second stage would be the family and friends investment round, where maybe, let's say, 500,000 or similar amount, or a couple of 100,000 are raised, possibly through equity or maybe through a convertible loan. And then we have the Series C, Series A, Series B stage, where the equity investment is dominant. And in between these stages, we may have mezzanine financing. And up to this stage, probably the company will not be able to have a revenue stream which would allow them to repay any interest. Also, it has to be kept in mind that for this reason, the company is not able and will probably not have no chance of receiving venture debt, because the equity debt ratio will be imbalanced. However, let's say we come up to Series C and have a steady revenue stream for the startup. There are cooperation agreements with, for example, let's say it's a medtech startup in the artificial intelligence area. They have cooperation with large medical companies. They have cooperation with hospitals. They have cooperation with academic institutions and so forth, and receive a clear revenue stream, a monthly revenue stream. They are not break even, but they have accessibility to capital, and they are able to repay certain amounts of venture debt. And so as you can see, the venture debt starts, let's say, at a lower amount here of 5 million, but then eventually from Series D increases to the same amount of a mezzanine financing. And this is a very interesting part of the venture debt, because it is very flexible and fastly accessible. It can actually allow the company to avoid a Series E or a Series F. And this step, this expansion phase, may be the crucial phase before the exit, where the company is at a point where it actually just needs to fulfill further KPIs or needs to acquire a competitor in order to get the value that the shareholders would expect, let's say a 3 times return on their initial equity investment. And this venture debt would then allow them to get the short-term financing, to acquire a competitor, to increase the revenue, to meet the KPIs, and then be attractive for an exit case. So this is a very, very vital key for all startups that have come and have surpassed, let's say, the initial stages. So to sum that up again, I think these are really the key advantages and the growth potential that venture debt can offer to startups. So add-on acquisitions, purchase, acquire a competitor, or a business that actually adds on value. Let's say, for example, in our example with a deep tech medical startup that produces an artificial intelligence solution for patients and illness analysis, a machine production company in that area that builds machines to perform operations on patients may be acquired, and that combination really triggers the valuation of the company that makes it an interesting exit case. Also, it could be that the company is just on the point before break even or to become cash flow positive, but just needs to hire further staff. Then also venture debt may make sense. And as shown in the example before, this really avoids that we need a further financing round, which also for a future exit scenario, investor and acquirer poses a very good image. Then also one other scenario where venture debt might make sense is to avoid a down round for the investors, because we usually have in the equity agreements an anti-dilution protection, which would allow the investors to receive further shares. So in order to avoid this, venture debt with a non-dilution effect could also really help the company to surpass a stage or surpass a time where the product is not let's say demanded to the amount it would be usually for whatever economic reasons or political reasons, and to surpass that stage, venture debt can be very strong. So maybe to show you in numbers, the development of venture debt has been stronger than the general venture capital market, and it has really outpaced the market. So this is a study from the Pitch book, which has analyzed a number of US deals in the years 2010 and in the year 2020. So we have actually, compared for venture capital, we have a 2.2x increase in deals. However, with venture debt, we have an increase of 3.1% or 3.1x. So this increase shows that there is a greater demand for venture debt. Also, of course, because the interest rates have lowered in the last years, so the availability of capital is also higher. And what's interesting in this curve, and that's why I picked this out, is that you actually see, well, in the first years, the number of deals increased significantly. However, in the last years, it has been rather steadily. So actually, in 2020, 37 venture debts with a volume of $17 billion accounted for 60% of the market. That means the size of the venture debt tickets is becoming enormous. And we have seen, for example, the Uber financing ticket of 4 billion, and also significant tickets for WeWork or for Airbnb in venture debt. So also one interesting feature of venture debt is that it really allows companies a massive growth and a massive fundraising within a short time frame, which would not be available in an equity funding. So now you've seen all the advantages and beauties of venture debt. You may, as a company, ask yourself, well, who could I approach regarding venture debt? Who are the players? So I've just listed a few here whom you may see or whom you may know. I think one of the significant ones is, and most famous one, is the Silicon Valley Bank. And of course, there are a number of others, mainly US and UK funding. However, there also is increasing other firms from, let's say, the European Investment Bank and so forth. And there are, of course, a number of more investors in this area. So generally what's tended to start for US banks now is really taking over, and more funds are joining this process. Also, let's say, for example, Columbia-like partners, who have been a classical venture capital investor, have now also moved on to venture debt. And this is a very good and interesting process, and it also requires different types of limited partners, but also opens up the possibilities of fundraising for such funds, because the beauty is that it has a recurring revenue and is not a closed fund that only allows a liquidation, or let's say a 3x or 10x revenue after 10 years. So this really is a very interesting and growing scene. All right, so after this, now I would like to take a deeper dive. So as I'm an attorney, of course, this cannot spare you this, that we will now be looking into the details of negotiations and the structure details of venture debt. And especially now, let's say we're in the stage as a deep tech startup. First of all, we've realized that there is something else than equity and mezzanine. We've learned something about venture debt. We've looked at the market. We understood that we are in the later stage where it makes sense. We've talked to a number of the venture debt providers, and now let's say we've received the first term sheet. And the question is really, what's the standard in the market? What are the terms? What do we need to look for? And how do we best negotiate this? So I've picked a number of topics which, from my perspective or from our perspective as a firm, are of relevant, especially in the term sheet negotiations, which then form the basis of the future documents. So the first one is the type of financial instrument. So of course you would say, well, it's a secured loan, but there are also other types which we'll look into just in a minute. Then it's the amount of the loan, the tranches, and the milestones. So how is the loan going to be paid out? Which amount can I request at which point in time? Then of course the term and the maturity. As a startup, I would be focused more into having a long-term period for the loan, so I don't have to repay the full loan at a certain point in time in the future. Then there's also the possibility of receiving an interest-only period where only interest needs to be paid and no part of the principal needs to be repaid, which is also very interesting as it really helps to protect the cash flow of the company. Of course, the interest rate is of importance. Then the facility fee, basically the fee to set up the structure. Also early repayment fee if I have a 5-year loan and I want to repay it after 3 years because I have an exit. Also very important to consider the M&A consent, and as well as the covenant, the warrants, deposit and information rights. So I would like to go into more detail in these topics with an example and a case study. So what we've done is we have compared we've compared 2 venture debt providers in a deal, in a transaction, which is completely anonymized, but may be of interest to you. So the background is, say, it was a deep tech startup, also in the medical area, who was raising funds in a venture debt transaction, and they were looking for 10 million euro to be raised plus 5 million optional funds for an M&A transaction. And I'd briefly like to go through the steps which we have negotiated and maybe help you to understand what you should be looking for if you negotiate a venture debt transaction. So the first point of discussion is which financial instrument to use. So the company was offered a standard loan, as you may know, and also a secured bearer bond. So what's the difference? Well, basically, a secured bearer bond allows the holder of the bearer bond, which is basically the recipient of a certain piece of paper where the terms and the issuer is signed and sealed, to hand that over to any other person they like. So the transferability is extremely high for that, which is a great advantage for the creditor, however, can be of detriment to the company issuing such bond, because the identity of your contract partner may change. So what we did in that case, we tried to very hard negotiate that such bearer bond may not be transferred to a third party, because if such bearer bond gets into the hand of an aggressive debt fund, then they may try anything to get a breach of covenant and then to get access to the assets and to the IP of the company. So this is a very important issue to look at. Then regarding the financial instrument, a venture debt loan, a venture debt will always come together with a warrant. So a warrant, basically, or in German, Anteilsbezugsrecht, is a claim to receive shares in the company. Basically, this is an instrument to either participate in a next financing round at a reduced valuation, in particular one of the last or preceding financing round, or it can be an instrument that actually allows an equity kicker at an exit or IPO. So this is also something that kind of reflects the venture aspect of the venture debt and is a fixed part. It usually focuses on 10% of the amount raised. So in this example, we had of the 15 million venture debt loan, we had a 1.5 million warrant. Then of course, and we'll take a deeper dive into the warrant afterwards and what it means and how it works. So of course, a key issue is the pledge of the assets and then further securities. So interesting, and this is something important also for the cash financing structure and planning, is which offers did the company receive in order to get those 15 million. So you can see the two offers of the venture debt provided different approaches. So the first one said, well, you can basically draw down 1 million straight away after we sign the contract. And then we have 3 different tranches, and those tranches are limited to a certain period of time and are granted if certain milestones are fulfilled. So these milestones correspond to your EBIT, right? So there's a financial covenant, so earnings before interest and taxes. Once you reach that stage, you will be able to receive such financing. So this is, let's say, the more traditional standard approach, and the first provider was actually a larger bank. So you can see that this commercial approach also will be found in a venture debt transaction, and it really makes a difference who is the provider of such debt. Will it be a traditional bank? Then they will be strongly looking at the EBIT, or in this other case, the second provider, who was actually rather a venture debt provider from the venture capital fund scene, was more flexible in that regard and actually allowed a 2 million drawdown right away, 5 million tranche 1, and then flexible tranches, and just as secure net to debt revenue, and also took into account the trailing 12-month approach in that, which is interesting. So the trailing 12 months actually looks backwards, not on a yearly perspective, but actually on the current last 12 months perspective, which allows the startup with a strong growth to actually achieve those. So these are very interesting approaches, and I think it's important to be able to compare those. So it's important for a deep tech startup when raising venture debt to also approach a large number, or let's say at least 2 or 3 venture debt providers in order to get different approaches. And you see that a bank will approach such financing very differently than a standard venture capital investor. Then again, you have just the term. Usually we have a 48 month, which is fairly standard for venture debt. So in this case, both quite parallel. And then, as stated before, also an interest-only period is standard. So for the first couple of months, you will have a period where you will only have to repay interest, and then the amortization of the whole loan will start. So these details are then further agreed in the payment schedule, where you can actually perform your cash flow calculation afterwards. Interesting is also the amount of the interest. So this will generally be based on the ECB base rate or on Euribor. So you generally have rates between, let's say 12 to 15%, so fairly high interest rates, which in the current market are extremely high, and of course reflect the risk that the venture debt secures. However, you will be able in certain cases to agree on a ceiling. So in this case, we were able negotiate a 12% ceiling, which for our client was a very good result. And also in the current interest scenario is something you could aim for. Then of course you should never forget the facility fee. This is quite important. So 1% of the total funds issued will be the fee for actually being able to receive such venture debt. So this is where the debt provider makes money. So this is also something to be kept in mind. And another very important issue for startups who raise venture debt is the repayment fee. Because let's say you have a 4-year venture debt and you receive that in a very late stage where you maybe be 2 or 3 years away from the exit, and the exit occurs after 2 years, then of course you will have to cancel the venture debt, and then you will have to pay an early repayment fee, and this can be significant. So for example, up to 5%. So if you think about, we have a 50 million loan and we have 5%, so 750,000 euros as a fee to be paid just to get rid of the venture debt. So this is something to keep in mind. And also, let's say, the part where the venture debt for the investors who provides us venture debt becomes very, very attractive, because they calculate on the scenario that there will be an earlier exit. Another important issue is, of course, if you plan to use the funds for further acquisition, that you are able to perform those acquisitions without the consent of the venture debt provider. So this is also, as you can see, at the more, let's say, risk open investor from the venture capital, they did not consider this required. However, the traditional bank considered that required. Then another issue to look at is also the cross default. So what does the cross default mean? Cross default basically means if a company defaults on any other liability, then also the venture debt defaults. So this is important, and this is something to be closely regarded in the contract documentation and to be negotiated with the issuer. So you should make sure that this does not occur unless the other liability is of a high level. So you should not be obliged to repay a 5 million venture debt right away if you fail to pay your, let's say, the lease for your office for 1 or 2 months. All right, so now we've covered the venture debts, and now we approach the warrant. As said, the warrant is an additional instrument. So 2 completely different contracts. One is the master loan contract, the other one is the warrant contract. And as stated, it is kind of an equity kicker that is additional to the loan and also of great value to the investor. So basically, it is, as you can see, and these are just examples, it is based on the price of the last financing round. And you can see here, so we have 1.5 million. So it's 10% of the 15 million, which is very standard. In this case, in the other case, we had a lower warrant, which then increased depending on which tranches of the loan had been drawn. So these are two methods to approach eventually this would get the investor also to 1.5 million warrant. So these are the 2 approaches to calculate this warrant. So you can see where there is flexibility in negotiation of a term sheet. Then of course there's always the deposit of the costs, and this is also to be kept in mind, that actually a venture debt, as it is of a major financial, let's say, implication and allows to raise large amount of funding, also incurs certain deposits and debts which need to be paid up front. So these are usually for legal or advisory costs. So this is also to be kept in mind. And also, although the venture debt investor is not a shareholder, they also require standard information rights, same as a shareholder, an equity shareholder. So these are also to be kept in mind. And really, this also again is the difference whether you talk to a bank or whether you talk to a venture capital fund. The venture capital fund will not have strict information rights, whereas the bank will have very strict and precise information rights. So this is also to be kept in mind. And the last point is really the collateral, and that is something I would like to stress, and which is of great importance when considering venture debt. Different to any convertible loan, the venture debt will make sure that any value of the company is pledged or assigned to the holder of the venture debt. So in case there's a default, then all the IP of the company, all the claims of the company, all the assets of the company, all the subsidiaries of the company will be owned by the venture debt creditor. And this is a complete different scenario to any other fundraising in this regard. So this is to be kept in mind, and this can be detrimental for the shareholders because they would lose all the value that actually is in the company. They would lose all the assets in case of a default, and therefore it is very, very important to make sure that the covenants and the cross-default clauses are really closely looked at and negotiated, and also that all information rights are duly followed. So these are really things to be kept in mind. So this is very different from a general equity investment. So what I would also like to show you, to highlight how sort of the payment in the future would look like. This is a screenshot from an actual payment schedule for a company. And this is something you will get once you have raised venture debt, which will show you as a company which payments need to be made in the future. And as you can see, this clearly shows in which month, which principal amount, which interest needs to be repaid. And this is detailed, this is calculated in detail. And there is also a certain flexibility. So according to your future investment, you should plan how much money you can allocate each month to repay the interest and repay the principal. And you need to be really diligent with that calculation to make sure that the company growth which you're planning is actually achievable. And there's also flexibility in having a certain amount in a bullet payment at maturity at the end. So this also will allow you to move forward certain amounts. In the end, once you reach that bullet payment, one thing that may happen is that you are not in the position to pay that, but hey, you can raise another venture debt, or you can take out another facility or tranche to repay that. So this gives great flexibility. So this was a deeper dive into an actual case study, and I would just like to use that opportunity if any questions come to mind before I move on and take a deeper look at the contractual structure of the venture debt. So please feel free to jump in if any questions are there from the audience.
If I may jump in, so you can either type your questions into the Q&A or chat, or raise your hand, and then you can, I'll give you the permission to speak. No question at this point in time. I would have one, if I may.
Sure.
So given what you've just said, that the venture debt creditor is receiving basically all the company value on default, in the process of negotiating, how are the existing shareholders, particularly venture capital funds, convinced to go with such an arrangement?
It's a very good question, and I think the main reason for doing so, to take on that risk, is actually by having the benefit of not being diluted through that funding process. So basically, let's say a venture capital investor holds 20% stake in the company, and the company, however, needs additional funds to be able to acquire a new business or to acquire a competitor. So effectively, if a new financing round would commence, then the investor would fall from 20% to 15% and would actually lose value in the end. However, with a venture debt, he would be able to keep his 20% and have such external financing and be able to take that growth step for the company. So this is the main reason for a current equity investor to stick to venture debt. So and there are also potential other reasons to do so, because an equity financing may not be available at such point in time, and also the flexibility for the company and the CFO are greater with the venture debt that can be provided much faster. So these are probably these are most of the reasons, but I think the dilution effect is the main reason.
Okay, thank you very much. There's another question, which in part you've kind of answered. How long does the overall process normally take to attract venture debt?
This is a very good question. So I would say, other than closing a convertible loan, which can be done in 2 to 3 weeks, the venture debts, as this is a very complex process, first of all, of negotiating the terms, then also finalizing the contracts, then also ensuring that all the security documents are in place, often involving other jurisdictions. This can take up, let's say, to 2 to 3 months probably. So this is a long-term process, and this is important to know. But however, once you have gone through that process, any further funds raised under this venture debt facility or any amendments to that can be done very swiftly within, say, 1 or 2 weeks. So for example, you have raised the $15 million venture debt, and it took 3 months to get all the documentation in place. In the future, afterwards, if you want to raise another 5 or another 10 million, that can be done very quickly. So that's an important thing to know. So I think the idea and the decision to receive venture debt is a long-term decision. So if you decide for venture debt, you should not do that and plan that for just one fundraising, but maybe for 2 or 3 additional fundraisings in the future.
I think that's it with questions.
Okay, great. So
move on.
Great. So I think this is also a very good keywords for the, let's say, the timeline and the complexity of actually being able to raise venture debts. Let's take a look into the contractual structure and what is required from a contractual point of view. So you all probably know what equity financing requires. It's an investment shareholders agreement, and it's a capital increase. A convertible loan is a convertible loan agreement. However, with venture debts, probably if you have not gone through that process already before, you may not be aware which contractual agreements are required. And I'd kind of like to lead you through those and give you an idea what it means, what's important to look at, and what's the timeline in order to conclude that. So the first and the major agreement is the master loan agreement. The master loan agreement basically includes all the terms which we've gone through in the case study. So the amount of the principal, the interest, the tranches, the payment, the covenants, and so forth, terms of condition, and is basically the key document. It's quite a fairly long document, and we'll take a look into the details in a minute. And it also includes certain annexes, which is the payment schedule, for example, which I've shown you, which is then agreed upon. Also a complete collateral disclosure that basically is a due diligence, includes the due diligence of the company. So any asset of the company must be listed and disclosed, because such asset will then be in the second stage pledged and assigned. So this is also important to know, and that this is also the reason why the timing for such funding in the first place will take fairly long, because unless there has been a very recent due diligence at the company, which actually shows all the available assets and lists them, the venture debt provider will have to thoroughly look into each asset and see its value, its availability, and whether it can be pledged or not. And this also, if you work as a, let's say, deep tech startup and you have certain subsidiaries, for example, you would have one in the US, you would have one in, let's say, Poland, you would have one in Spain. All of these subsidiaries need to be looked at and need to be evaluated. And this can take a certain amount of time. And then another part of the master loan agreement is the closing certificate. So because different than, let's say, a financing round, usually these documents are not notarized. So, but they are really a large number of documents, let's say. So they usually have just taken this one. This is a documentation for a venture debt funding. So if you can see this picture, you can see that's about a 200-page documentation. So the closing certificate is basically the certificate that combines all other certificates together as one. And the process of combining all those annexes and documents will also take a certain amount of time, which must be kept in mind. So this is the first key document, and this is the main document of negotiation. Then additional to that document are all this collateral and security documents, which each individual carry the IP pledges and the pledges of all values to the company. So if we look at the deep tech startup and with a complex technology, the most valuable asset is the IP. And the question, of course, is how can this IP and this code be pledged from a legal and technical point of view? So what happens is an agreement is, of course, concluded where all IP is pledged. So pledge in this way means that in case the venture debt and the venture debt payments under the payment schedule are not made and the loan defaults, then the venture debt creditor will have a claim to this IP. And this IP is then usually, and the source code is usually transmitted to a USB stick or burned to a CD. And this CD is then put into escrow, either with a notary or with a escrow provider who will then place this USB stick and CD in a safe, lock it up, and in a different safe will lock up the access code to this IP. So basically, if a default scenario occurs, then the venture debt creditor could knock on the door of this escrow provider, ask for the code and ask for the USB stick, and then use the source code for themselves. So this is a very, let's say, new approach, and and the notaries we have been working with, they were quite surprised at the beginning how to really handle this, but this is how actually the IP is secured. And then the other security documents are fairly standard. So the bank account pledge occurs by informing the bank and sending the required document, and also the shares of the subsidiary are being pledged, and this often involves other jurisdictions. For example, in our example, a US attorney, other European attorneys who will then have to make sure those shares are pledged duly under the respective jurisdiction. And then once all this collateral is secured, there's the third and important document that needs to be negotiated, the warrant agreement. So basically this additional equity kicker right, which makes an exit scenario for the venture debt creditor more attractive. So for this, generally authorized capital is created. So an amount of share capital is reserved just for this purpose. And this is made part of the Articles of Association. And this resolution needs to be notarized. And also the shareholders need to approve this. So this is basically the contractual structure. And we will now just give you a brief outline what is actually included in the documents. Once you will see those, once you'll have to negotiate those, that you have a basic idea. So the master loan agreement, as said, contains the key terms as already described below, and you can see from those that these are the issues we have discussed. Also tax and event of default is important. One thing I want to stress is the assignment. Again, very important to keep an eye on this, that assigning of a loan should be very limited in order to avoid that it's actually handed over to an aggressive debt fund. And then the further annexes. And regarding the covenants, this is something for which I'd also like to briefly look into what the venture debt providers are looking for. So these are basically the 4 key covenants which you would find in the document. So one is basically the equity ratio, which is very important. So there must be a certain amount of equity available in order to repay the interest and principal, as shown in the figure before, that actually, you know, venture debt will not be possible without a fundraising in equity. Then the gearing ratio, so the company should not have too many other liabilities to make sure that the repayment can be guaranteed of the interest, and also no over indebtedness is created. Interest cover ratio, probably known to some of you, that the EBIT is available and actually can be used for repayment, and also the current ratio, which is standard mathematical ratio applied in order to avoid insolvency. So these standard ratios also are included in the contractual agreements. Then just briefly on the warrant agreement, without really going into detail, these are the standard terms you would expect. And basically you can see that's similar maybe to the calculations you may know from a convertible loan. Also, there are exercise events defined. What is an exit? When could it be converted? Then there's an automated exercise in case a certain time period is reached, or in case an exit is reached or an IPO is reached. And then also what is interesting is that the warrant does not necessarily have to be converted into equity. It can also just be a financial instrument that is then also paid out just the, let's say, the profit, and no conversion is required. Also, co-investment right is often included, where the venture debt could also co-invest together with other investors. So all these forms are also part of the warrant agreement. So to come to a conclusion, I would like to briefly give you an overview. What are actually the pros and the cons of venture debt financing? And this overview compares the basically available financing measures from equity, mezzanine, and venture debt, and kind of briefly shows you, if you have to make a decision, whether you want to either raise venture debt, or whether you as an investor consider offering venture debt. So the most important issue is the dilution effect, and that is the reason why any other equity investor would be willing to take on venture debt in the fund. So there's no dilution for the shareholders, which is in all other cases the detriment. Then on the other hand, there's of course the insolvency risk that is avoided by equity and mezzanine financing due to the subordination, which is not the case for venture debt. There will never be a subordination. It's always a senior loan. So unless the company has sufficient equity, unless the company has sufficient revenue, the risk of over-indebtedness is imminent with venture debt, and therefore it's nothing for an early stage investment. Also, an important criteria is the leverage. So the leverage effect, so reducing your taxable revenue, is not existent with equity or mezzanine, but it is existent with venture debt. So the interest rate can always be deducted from the revenue, and I will have less taxes to pay. So this is a great advantage, and for a later stage startup, very important. Another issue is the future repayment, which needs to be kept in mind. So this is a disadvantage of venture debt, because of course, once there will be the time when the bullet payment is due, and then there will be a significant repayment amount, and there's no chance of converting this into equity as with mezzanine capital. So there will be a point in time where it needs to be repaid, and this is a detriment, and this is an argument contra venture debt. However, if an exit or IPO occurs, of course, such repayment can take place. But then again, as stated before, it needs to be taken into account that there will be an early repayment fee, significant one up to 5%, which needs to be taken into account when looking into venture debt, which is not the case with any equity funding, but it may be the case with mezzanine if there's also an equity kicker, but if it's converted earlier, then there's also not such detriment. However, a great advantage, and I think this is really one of the key issues for a growing startup, is the short-term availability. Also, the add-on availability of venture debt, which is greater than with equity, and also in the amount effectively greater than mezzanine capital. So the total result is that it actually can equal out equity and mezzanine financing, and therefore venture debt is a very interesting new financing tool which any deep tech startup at a later stage should consider. So with this, I come to the end of the presentation. Any questions from you, please go ahead and shoot, and I'm happy to answer those.
So not from the audience so far. I would have another one. So in case of an exit, say via an IPO, and I switch on my camera also again, how does the venture debt impact on the enterprise value via, for instance, the debt equity, or increasing the debt equity ratio? Is that a beneficial effect, or much to the contrary, rather not? Or what's your experience with kind of this situation?
So I think for an exit scenario, and as shown in the list, it needs to be taken into account that there will be additional costs for repayment of the venture debt. So it will not be as critical regarding the debt equity ratio, because in an exit scenario, all debts will be repaid, and the equity holders will then receive their stake. However, of course, the higher this repayment obligation and those additional fees that are due for the venture debt, if there is an earlier exit than expected, these of course will then eventually reduce the value that is attributed to the shareholders. But since it can really bridge the gap for the acquirer, it does not make a difference whether they say, okay, well, the company valuation is, let's say, 100 million, and we deduct the 10 million outstanding venture debt from this valuation. Effectively, the acquirer will pay 100 million, will pay 10 million of those to the venture debt provider and the rest to the equity holders. So from this point of view, it would not make a great difference. With an IPO, however, and that is a key issue, and then this is why this question is very good. It is very important to negotiate what happens with the warrant, because the warrant is usually an instrument that's, in the eyes of the venture debt provider, can be rolled over. So what they would like to have is actually that the warrant becomes then, let's say, also a flexible warrant with regards to future publicly traded shares. And this is how they treat them. And of course, this may not please anyone who plans the IPO, and this is an important issue to keep in mind. And also, let's say, usually you would say, well, once we have an IPO or once we have an exit, we only discuss with the shareholders, but you always have to keep in mind the venture debt provider also takes in, let's say, a semi-shareholder role. So he will also be part of the negotiation table when it comes to an exit and an IPO. So you will have an additional player. So this also needs to be kept in mind. So I think these are the factors. I think from a financial perspective, for an exit, it does not make a difference. For an IPO perspective, probably the warrant, but from a negotiation perspective, of course, you need to include the venture debt provider.
Thanks very much. Any more questions? I think it was a lot of information to digest to begin with, so people might be a bit overwhelmed and sorting the information.
No, I mean, if any questions come up, also available afterwards, and happy to continue the discussion. And I think it's maybe as you may have seen, it is a very complex instrument, and there's a lot to take into account. But I think in the long term, it will also be more standardized, and it will also be more, let's say, acquainted with the venture capital scene, and hopefully take an important role in this regard.
Well, then, unless there are any questions, last chance for everybody. I would like to thank you very, very much, Benedikt, for this really, really detailed deep dive into the issue of venture debt. It's been very, very instructive, and